most of them are in price. So if you see auto ancillaries have fallen a lot, most of the export oriented sector including IT has fallen a lot. So FY26 earnings slowdown is broadly there in price.
Which are the sectors that could see a favorable scenario and which are the sectors that could be impacted the most?
The earning downgrades are for FY26 are already in price because markets nowadays are very active. Rather than acting on the same, it is better to stay invested, better to stay invested in a disciplined manner rather than trying to take market call.
Hello all, welcome to Moneynomics. Today we have with us Shreyash Devalkar, Head Equity at the Axis Mutual Fund, and he will talk to us about the latest developments in equities. So Shreyash, let's get started. Now, what do you think in lieu of the tariff wars playing out? What is the state of markets in India and globally?
This tariff war, the way it has started, there are a lot of uncertainties. The point is that sometime the tariffs were high, sometime back, just few weeks ago, and now they are lower. So this situation is evolving, and that's where to expect that supply chains will change so soon. It will be difficult to expect. So initially, what is driving is indecision. Indecision by corporate across the group. So in my opinion, the private sector not taking any decision, whether it is about the capex or even it is about changing supply chains, is the first thing to happen. In that scenario, there are going to be certain earning cuts to be expected for FY26 because of this indecision. Eventually, the ultimate expectation is that there should be change in the supply chain, whether part of it will shift to US or part of it getting shifted to other countries, ex of China. That scenario will evolve based on the comparative advantage of individual country.
One thing is very clear, that growth is going to slow down for all countries. How do you see growth in your view in India and in the US?
As far as India is concerned, our dependence on export is not very high compared to other countries, some of the other Asian countries like China or Vietnam, as well Mexico. And because of that, since our economy is relatively diversified, the overall impact is going to be lesser than other countries. So as per various estimates, it's coming out to around 0.5 to 1% odd. Sector specific, obviously there is going to be impact on multiple sectors. That impact may be in export oriented sector, especially auto and auto ancillary. It may be there in IT because of indecision again by the global corporates, and thirdly in capex oriented sector in some time to come, more because again it's to do with the indecision in uncertain environment. So these few segments may face issue in this.
Okay, so when you're talking about these sectors, let us also talk about how you are positioning in your funds. We know that you have always been mostly underweight exports. So what are the changes that you're making to your sectors in terms of the positioning?
Actually, as far as changes in portfolios are concerned, they were driven by relatively high valuation in export and investment oriented sector. So that process for us started somewhere in September, or actually it started somewhere in June to September time period, and that process has been on. During that process, what we did is we reduced exposure to export oriented sectors. Actually, at point in time we reduced auto ancillary, we reduced earlier capital goods and IT as well. At the same time, this money actually went into other sectors which were not re-rated. Actually, some of them were de-rated compared to their pre-COVID valuations. So those sectors are broadly, in case of large caps, it has been private sector banks. Some of them went into retail industry also, and pharmaceuticals. So these are the key sectors where this money for us has gone. But it is not to do with this, it was more based on the risk reward framework, and it has happened over last 6 months.
Okay. You spoke about earning downgrades happening in FY26. We have an upcoming earning season. It's almost begun. So where do you think, which are the sectors that could see a favorable scenario and which are the sectors that could be impacted the most?
In my opinion, earning downgrade may be expected in most sector. Already few result previews which are already out. The earning growth for this quarter is actually low single digit. That is the expectation of. In which always when you look at the overall market level estimates, there are commodity oriented sectors and all, and those drive most of these movements. But broadly, in my opinion, the earning downgrades are for FY26 are already in price, because markets nowadays are very active, and earning downgrade actually is becoming a lag indicator rather than the lead indicator. So in my judgment, FY26 earning downgrades are already in price. The call to be taken is whether there is going to be sustained slowdown or not. Just to take a parallel of COVID scenario. So if you recollect, in FY21, there was an earning downgrade, and in FY22, the expectation was it will sustain and it will not recover. However, in FY22, there was earning growth, and then the market recovered a lot. So here also, as far as FY26 downgrades are concerned, broadly in my opinion, most of them are in price. So if you see, auto ancillaries have fallen a lot. Most of the export-oriented sector, including IT, has fallen a lot. So FY26 earnings slowdown is broadly there in price. Whether it is going to sustain in FY27 and it is going to be a sustained slowdown, that remains unanswered questions as of now.
Okay. So now that you have spoken about all of this, against this backdrop, what should investors be looking at when they invest in equities? Also, in such uncertain times, investors usually want to pull the plug and withdraw some money, or they always are hesitant to add in more money to mutual funds. What would your advice to investors be?
Actually, if you go by history, so currently it is tariff related. Sometime back it was COVID, sometime back it was ILFS, and so on. These corrections we have seen multiple point in time. When the corrections happen, generally we end up painting a gloom and doom scenario for the market, and rather than acting on the same, it is better to stay invested, better to stay invested in a disciplined manner rather than trying to take market call. Already there is enough research available which suggests that time spent in the market is more important than timing the market.
Absolutely.
So considering this, one should stay invested.
That was quite an insightful session, Shreyash, and I think investors have a lot of key takeaways from this conversation. Thank you so much, and thank you to all our viewers for joining in. Stay tuned to Moneynomics.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.